Welcome to Iraqi Dinar today. This is not noise, not fantasy, and not emotional speculation. This is a structured exit approach that most banks will never openly advertise. Stay with me carefully, because what you understand today will determine how smoothly you move when the time comes. By the end of this, you will know the preparation steps many holders ignore, the exact conversations to have with financial institutions, and how to position yourself like a professional instead of a hopeful investor. As of February 28, 2026, the exchange environment remains policy managed. The rate operates within a controlled structure, meaning it is supported by monetary policy rather than free-floating volatility. Some see that as stagnation. Strategic planners see opportunity. Stability provides time. Time allows preparation. Preparation reduces costly mistakes. Here is the first principle. Large foreign currency transactions are not treated like everyday exchanges. Major banks operate structured foreign exchange departments. These desks follow compliance protocols. When you call and state you hold physical Iraqi dinar for exchange, expect direct questions. They will ask about total volume, denominations, purchase timeline, and source funds. This is standard anti-money laundering compliance. It is not suspicion. It is regulation. Your readiness determines efficiency. Build a structured file immediately. Include valid government identification, purchase confirmations, bank transfer records if available, and a detailed denomination breakdown. Know the institutions by rate versus sell rate. The spread is where banks generate revenue. On significant amounts, even a fractional percentage difference can represent a major dollar impact. If you appreciate disciplined preparation over speculation, press like, share this with serious currency holders, and comment prepared if your documentation file is already in progress. Understand this clearly. Institutions slow transactions when clients appear unorganized. That delay is procedural. Compliance protects both sides. What comes next is critical. Most investors confuse redenomination with revaluation, and that misunderstanding leads to unrealistic expectations. Stay focused, because clarity here changes everything. One of the most misunderstood topics in currency discussions is the difference between redenomination and revaluation. These are not interchangeable terms. Confusing them leads to unrealistic expectations and poor financial decisions. Redenomination changes the face value of notes inside a country. It adjusts the number printed on the currency to simplify accounting and daily transactions. For example, a 25,000 note could become a 25 note in a new series. The purchasing power inside the country remains the same. The math simply removes zeros. Internationally, that action alone does not multiply value. It is an accounting adjustment, not wealth creation. Revaluation is different. A revaluation is an upward adjustment in exchange value against other currencies, typically influenced by macroeconomic fundamentals, foreign reserves, trade balances, and investor confidence. It reflects external value movement. It is driven by policy credibility and market dynamics, not cosmetic currency reform. If you hold physical notes and a redenomination occurs, you would exchange old notes for new ones at the official conversion ratio. Your purchasing power remains equivalent. There is no automatic increase in international dollar value, simply because the note looks different. That distinction eliminates many unrealistic claims circulating online. Professionals monitor institutional reforms, liquidity access, correspondent banking relationships, and policy announcements. Those are measurable indicators. Social media rumors are not indicators. If this clarification helps you separate fact from fiction, press like, share this with someone who still believes the two terms are identical, and comment clear if you now understand the difference. Now shift your attention to operational logistics. Major banks do not handle large foreign currency exchanges casually. There are internal thresholds. There are branch limits. There are specialized desks for verification and compliance. Walking into a small local branch with substantial physical notes may result in referral to a foreign exchange department that works strictly by appointment. You must call ahead. Request a foreign exchange desk. Ask about documentation requirements, denomination limits, verification timelines, and settlement procedures. Ask how the buy rate is determined and whether additional fees apply. Ask if proceeds are credited to an account or distributed as cash. Request written confirmation of responses. Preparation eliminates surprises. In a moment, we will address exactly how to structure that call and what language positions you for serious treatment by financial institutions. Stay attentive. When you contact a bank, structure the conversation with precision. Do not improvise. Do not overexplain. Speak clearly and professionally. Introduce yourself and state you hold physical Iraqi Dinar and would like to schedule a foreign currency exchange appointment. Ask to be transferred to the foreign exchange department or the manager responsible for international currency transactions. Avoid general customer service when possible. You need the desk that handles compliance and verification. Then move through direct questions. Can your institution accept physical IQD notes for conversion to USD? What documentation is required for large cash foreign currency transactions? Are there denomination or total amount limits per appointment? What is your current buy rate, and how is the spread calculated? Are there additional fixed handling fees or percentage fees? How long does verification and settlement typically take? Will proceeds be credited to an account, or can they be dispersed differently? Is an appointment mandatory for substantial amounts? Ask for a written confirmation by email. This creates a record. Documentation protects you if terms change later. Also ask for the full name and title of the person providing the information. Formal communication reduces misunderstandings. When you arrive for an appointment, insist on transparency. The notes should be counted in your presence using machine verification. Request a denomination breakdown printed on official letterhead. If any notes are rejected, request written clarification explaining why and outlining next steps. Keep copies of everything. Receipts, count sheets, exchange confirmations. If permitted, document the process. Traceability matters, especially if tax authorities later request proof of transaction details. If this operational clarity is helping you build confidence, press like, share this with disciplined investors, and comment structured if you're preparing your bank contact list. Now we must address taxation. This is where many people make irreversible mistakes. Currency conversion at a gain can trigger tax obligations depending on your jurisdiction. The classification may fall under ordinary income or capital gains rules. The holding period may influence treatment. Cost basis documentation is critical. Speak to a qualified tax professional before any exchange occurs. Explain that you are preparing for a significant foreign currency conversion. Ask how gains will be calculated. Ask how to document original purchase cost. If notes were acquired over time, determine how basis tracking applies. Immediately after any successful exchange, allocate a reserve for taxes. Place that reserve in a secure, liquid instrument, such as insured deposits or short-term government securities. This is capital preservation, not speculation. Next, we will confront the emotional and psychological risks that cause investors to lose discipline at the most critical moment. Stay focused. The emotional dimension of long-term currency holding is rarely discussed, yet it is one of the largest risk factors. Years of waiting create attachment. Attachment clouds judgment. Hope can override logic. Frustration can trigger impulsive decisions. Both are dangerous when large sums are involved. You must operate under rules, not feelings. First rule, verify information through official institutional channels. Policy shifts are reflected in central bank releases, regulatory notices, and formal banking communications, not private chat groups. Second rule, never send money or currency to individuals claiming access to private redemption centers or special contract rates. Regulated banks do not require secrecy fees or insider payments. Third rule, separate proceeds into defined categories immediately after exchange. One account for tax reserves, one for debt reduction if applicable, one for long-term capital allocation. Compartmentalization prevents emotional overspending. Fourth rule, avoid pressure decisions. Urgency is a manipulation tactic frequently used in financial scams. If someone demands immediate action without documentation, disengage. If you agree discipline matters more than excitement, press like, share this with serious holders, and comment discipline to reinforce the mindset publicly. Scams thrive in environments where expectations are high and timelines are uncertain. Common warning signs include guaranteed revaluation claims, promises of above-bank exchange rates, requests for upfront processing fees, or instructions to maintain secrecy. If an offer exceeds regulated bank terms without formal documentation, it is a counterparty risk. Counterparty risk means the other party may fail to deliver payment, leaving you with no institutional recourse. Always verify licensing. In the United States, regulatory oversight includes agencies such as the Federal Deposit Insurance Corporation and the Securities and Exchange Commission. In other jurisdictions, equivalent regulatory bodies publish lists of authorized financial institutions. Use those lists before engaging any third party. Timing also requires realism. If a significant currency shift occurs, institutions will manage liquidity carefully. Large banks typically have better correspondent relationships and deeper dollar reserves. Smaller institutions may require additional settlement time. Ask about settlement chains and whether correspondent banks are involved. Preparation reduces anxiety during operational delays. In the final segment, we will consolidate everything into a precise, actionable checklist you can implement immediately to secure your position. Stay with me carefully. Execution now becomes your advantage. Preparation without action is incomplete. Before you ever walk into a bank, finalize a structured checklist and follow it exactly. Create 2 secure folders, one physical, one digital. Include government ID, purchase receipts, transfer confirmations, written statements for gifted currency if applicable, and a complete denomination inventory. If documentation is incomplete, consult a legal or tax professional before proceeding. Never fabricate records. Transparency is protection. Contact at least 3 major financial institutions and request written confirmation of their buy rate, spread calculation, additional fees, verification process, and estimated settlement time. Compare offers numerically. Even a small spread difference can materially impact large exchanges. Ask whether improved pricing is available for account holders or negotiated transactions. Institutions sometimes adjust terms when competition exists. Schedule appointments. Do not arrive unannounced with substantial physical notes. Confirm which branch handles high-value foreign currency verification. Plan secure transportation. If the amount is significant, avoid traveling alone. Risk management includes physical security. During exchange, ensure machine counting occurs in your presence. Request printed verification summaries on official letterhead. Retain every receipt and confirmation. Immediately after settlement, transfer a calculated tax reserve into a separate insured account or short-term government instrument. Capital preservation comes first. If any compliance hold occurs, request written explanation and timeline. Escalate professionally through compliance management channels if necessary. Document every interaction. Written records prevent disputes. Build your advisory team before movement happens. That team should include a trusted bank contact, a qualified tax professional, and legal counsel if your situation is complex. Interview them. Confirm experience with foreign currency transactions. A modest advisory cost is insignificant compared to potential regulatory or tax missteps. If this full framework has provided clarity and structure, press like, share this with serious currency holders, and subscribe for disciplined updates grounded in institutional reality. Comment below with your top preparation step so others can learn from it. Stay calm. Stay documented. Stay strategic. The opportunity, if it comes, will reward those who prepared, not those who reacted.